Yeah, no, that makes a ton of sense. Okay, I want to go back to a term you used. The velocity has been in markets, and as the way that you framed it made me make the link that perhaps a lot of the short termism that we've seen in financial markets and the velocity pickup there because of all this phenomenal momentum that pretty much stopped, I'd argue, back in February of last year, that changed the stock market in particular from uh, a leading indicator to a more coincident one, right? And traditional investing, traditional finance would argue that the stock market is a discounting mechanism of future cash flows, but it's hard for people to invest based on cash flows when they tend to just invest based on a chart. I'm curious, how do you think about the wealth effect here, and if the stock market perhaps is more of a disinflationary or inflationary force, than anything the Fed could do, because this reverse wealth effect, I think, is real, but obviously it's not yet filtered into slowing inflation.
So I think the wealth effect is an important variable. It is mainly a variable for the initially, at least for the top 10% of the population that owns the vast majority of financial assets. So, for example, top 10% of U.S. own something like 89% of equities in the U.S. And the other 90% is they own the other 11% of equities. So when the stock market goes down 20%, 30%, the immediate impacts are really impacting about 10% of us the most. And like as we previously discussed with the topic of wealth concentration, we're not the ones doing a lot of the, say, commodity consumption. We're doing the other types of consumption, and whereas the bottom 90% are still responsible for the majority of consumption because everybody has needs. Everybody, someone who's worth 1,000 times more than someone else doesn't consume 1,000 times more things just because they still have one body to work with, and so. The wealth concentration effect, the wealth effect is real, but it takes time to trickle through because as people spend less, they also then, hire less, and then those people can spend less. And so it is this process that takes time to play out. Another thing is that, we've never really had the stock market as this big of a percentage of the economy before. It hit over 200% of the economy. And so it used to be that the economy, going up or down, or really, because the stocks would front run it, the anticipation of the economy going up or down would influence stocks. Whereas now stocks are so big that the tail can wag the dog. That, a declining stock market, a declining bond market, we're so financialized, especially in the U.S., but also elsewhere with certain, countries with very highly valued housing markets, that can really wag the dog in terms of economic activity. And so I do think that the Fed trying to put the brakes on asset markets is a disinflationary tool, but it's a very blunt one. And it's really, it takes time to trickle through, and it's really directly impacting, 10, 20% of the population for the most part. And it takes time to reach those other parts. And so I think the overall approach of trying to rein in demand in order to combat inflation is ultimately going to be seen as short-sighted, in the sense that, as soon as we return to a period of growth, let's say we go into a recession and then policymakers are forced to stimulate, the inflationary forces would quickly reemerge if the supply side, especially the natural resources side, remains unaddressed. So I think ultimately we only return to a period of disinflationary growth if we improve the supply side. And so some of that takes time. So I would describe this as we have a structural inflationary problem going forward, but there are transitory factors overlaid on top of that. Things like, logistics problems related to Chinese lockdowns and Russia's war. There are these things that, could end next year based on certain human decisions. But then the overall lack of capex in the natural resources sector is something that I think will take years. And that trying to rein in demand is kind of like holding a beach ball underwater, where we might be able to get prices down for periods of time, but then they're ready to pop back up as soon as we try to reinflate.
I'm glad you mentioned that distinction between the sort of 10, 20% that are impacted by markets, and everybody else, the 80, 90, depending on whatever metric you want to use. Because you're right. The asset that matters for the vast majority of Americans isn't really the value of their stocks. It's more the value of their homes. So let's talk about the housing market here for a bit, because the Fed itself in 2008 basically alludes to the idea that whenever they talk about the wealth effect, they're talking less about equities and more about real estate, more about the value of homes. And you can argue that, if you want to try to really slow down demand for commodities, you probably have to do it on the construction side at the margin, right? So there could be some interesting dynamics there. But talk about how you're viewing the housing market. I understand your thesis around it's going to be zip code and location specific, but there are arguments to be made that the entire uh, asset class of housing, of real estate, probably is overall due for its own corrective period because you have this mortgage rate shock here.
I think it's in broad terms overvalued, and that it's likely to correct in terms of sideways choppy stagnation for a period of time. But of course, as you mentioned, it'll be zip code dependent. Some zip codes will keep going up, other ones will go down. There's cyclical markets, there's more cash flow markets. And I think overall it's likely to stagnate for a period of time. One way to quantify how big of an impact that is, so that's, as you point out, that's one area of the wealth effect that can hit the middle class pretty hard. And so, for example, if you look at the Case-Shiller index, the typical house is up like 20% in price over the past year. And then also, mortgage rates went from like 3% to like 5.5%, 5.2% or something, 5.25% over that past year. And so if you actually, if your mortgage is 20% larger and your interest rate went from 3% to 5.25%, that represents something like a 50% increase in monthly cost for that house. Even though the house price itself didn't go up 50%, the actual the cost to actually buy that house with a mortgage is up significantly. The same house, and so that represents either a slowdown in activity, which we're seeing, and it also can represent for people that have to buy that house. Like say they're moving and they have to buy that house. That's less money that they have discretionary to spend elsewhere on the economy, and so you can see weaker retail activity and weaker other types of discretionary activity. And so I think that squeeze on housing is a significant reason why we are entering an economic slowdown and why we might even be entering a recession at some point.
Yeah, and it's also why I have lumber and gold eyes, for whatever it's worth, because it's not my opinion, economically, and I know you've seen a lot of this work too, Lyn, housing tends to be a leading indicator of recessions because of knock-on effects of the entire chain of activities that happens from construction to the actual home being built, but and in terms of credit creation with home values, but also historically, usually when you have a massive tail risk event in equities, lumber in particular is weak in advance of that. And again, that's not my opinion. I can show that based on that 2015 Founders Award paper. Of course, there are always false signals in that, right? And that's an important thing I want to kind of talk about before bringing the audience. I always make it a point that historically, every major crash, correction, bear market is preceded by either weakness in lumber and or strength in utilities and or strength in treasuries. Oftentimes, they'll kind of give the same message in advance of the conditions favoring the accident, but not every time, right? It's kind of like if A equals B, but B doesn't necessarily equal A, so to speak. When you think about your macro thesis and going back to that point about systems analysis, uh, how do you try to adjust for periods where you might be in a false positive in terms of the variables that you're looking at? Because nothing is foolproof. No approach is ever infallible. And you've got to be able to be dynamic in a mentality. But what makes you maybe pivot your macro view to something entirely different?
So one is that I try to map things in rate of change terms rather than absolute terms. And so I'm constantly monitoring, are things getting better or worse from whatever level they're currently on? And I'm always super sensitive to false, turns. And so one thing I point out during the past economic expansion, which was over a decade long, you had 3 mini cycles within that expansion. So we can define those as rising and falling PMI cycles, purchasing managers index cycles. They were roughly these 3-year periods. And so we had these soft patches, which were kind of like near recessions. And they didn't manifest in full recessions for one reason or another. And so it's hard to outright predict a recession ahead of time, but you can say, is economic data accelerating or decelerating? And you can further break that down into, leading indicators, coincident indicators, lagging indicators. and say, in particular, you can say, what are the leading indicators telling us? Are they getting better? Or are they worse? And are they pointing severe or mild? And so it comes down to having this, step back, broad macro view, this framework for understanding the world, but then also, looking at these 6-12 month forward periods and say, what is the data telling us now? And then being able to adjust with that. And I think another way to deal with uncertainty is to not do these absolute portfolio changes. And so, for example, I don't rapidly change the portfolio based on what's happening in these expectations, but I do tilt the portfolio. So I'll have more of a defensive tilt. I'll have more of an aggressive tilt based on my perception of the opportunity set. And then as we, get more in one direction, I can dial that somewhat like a knob rather than this on-off switch. And so that's somewhat how I approach these inherent uncertainties in markets, is basically just constantly mapping things, see how it's developing over time, and then having kind of this inherent diversification base, which I then tilt in the direction that I think things are going, rather than go all in on that direction. So it's a great question. Yeah, I haven't studied the public perception in the UK during the 40s and 50s as close as I have some other topics. So it's not a subject I'm very familiar with. One of the books to be aware of, I think, is Ray Dalio's Changing World Order. And I don't agree with every aspect of it, but it kind of goes into mapping by multiple metrics as quantitatively as possible some of these rising and falling economies. And so you could see, for example, multiple metrics of the UK going down in that period, while the US was rising on multiple metrics and really hitting our peak really in the 40s, 50s, and 60s by some of these earlier metrics. And there are some that are, again, leading and lagging. I don't have the charts in front of me, but for example, education quality tends to be leading, and it tends to be one of the leading ones in terms of strengthening or weakening kind of global powers. Whereas the lagging one is actually the currency strength. Currencies, because there's a network effect there that built up over a long time, that's not something that turns on a dime. And so generally the reach of that global power has already fallen significantly by the time their currency starts being shifted out in favor of another system. And so I would recommend that book. Again, there might be aspects I agree or disagree with it, but I think it's worth being familiar with if you're interested in that topic. As to how the UK public in particular felt during the 40s and 50s, that's just not one of my strong areas. So overall, basically, I'm going to be tilted towards value, towards real world things like pipelines, things like healthcare stocks that tend to do better in these more inflationary types of environments. And my overall view has been that this will be a longer term inflation, but that it won't be a straight line. I mean, even in the 40s and 70s, you had rising and falling periods of inflation. And so it's not like I think just, inflation is like this straight line up throughout the whole 2020s. I think there will be pushbacks. I think we're in the middle of an attempted pushback. So you can get these disinflationary cycles within an inflationary decade. That's kind of how my base case sees this playing out. And right now the market is pricing this as being very transitory. And so, for example, tips aside, if you look at oil futures, oil futures for 2024, 2025 are way lower priced than current oil prices. And so the market is looking at this as war related and reopening related and very transitory. And like I said before, there are some transitory overlays on this whole thing that can be, altered one way or another by human decisions. But I think that so I think the market still believes it's transitory, and I think that there's still alpha to be had by, if someone's correct, that inflation is going to be longer lasting than the markets think, and that the Fed trying to rein in demand destruction is going to be insufficient to address that, and that's going to end up, they're going to end up being forced to reverse on that at some point, with the inflationary supply side things still somewhat unaddressed. And so my overall approach is to remain overweight, the natural resources sector, despite the fact that I do expect some violent pullbacks along the way, and to overall kind of just, focus on those more inflationary types of assets, while using some disinflationary assets as hedges. I often like to joke that cash is the one speculative asset that I own, because it's the one thing that I own that I know for sure is going to go down in the long run, but that I own it for periods of time because I expect it to probably go up in the near term. And so I think that's how I'm approaching this, is to have an inflationary outlook, but then to be defensive at certain periods as I expect attempted pushbacks on that inflation.